Welcome back. Sam, before the break, you were talking about risk. So, how should people manage their risk? What are some of the things that they need to think about?
So the risk tolerance questionnaires that most investors will fill out when opening up an investment account looks at supposedly the tolerance to volatility that that investor has. And what I mean by that is how much volatility is how much the value of the investment moves up and down. But stock volatility is the one way to think of it is like a roller coaster that does loop the loops. So if you don't try to get off in the middle of the ride and can wait till the ride ends, you should be fine. But if you think you can't handle the loops, it's better for you not to get on the ride at all. And the one concern that I have with this focus on volatility is that I think it misses the fact that investing is all about trade offs. So a tolerance to the volatility must be traded off against tolerance for fall. Now, you mentioned at the outset, Saijal, that you could keep your money in a savings account, but that there is a risk of doing that. And you're
Mhm.
absolutely right. The risk is that you will run out of money in retirement. Now, the alternative is that you can invest in high risk meme stocks or cryptocurrency, but then you run the risk of losing your capital. And the reality for investors is there is no either or answer. Every investor will need to balance volatility risk against shortfall risk. And where in that continuum the investor finds themselves most comfortable is what's going to determine their optimal investment strategy. I would say that one way to think of it is at the end of the day, risk is what you buy your return with. The more risk that you take, the more return you can potentially make.
Sam, let me ask you this. I mean, you talked about, when you work with an advisor, and I think you're referring to the KYC form or Know Your Client form, where they're asked a series of questions, and one is definitely on the risk tolerance. Do you think that the industry itself is also missing something, that they don't get that? There's gaps here?
We could have a long conversation about it. I think there is, in certainly, there is an element of things that are missing. I think the fact is, it is very difficult to measure something that is, at the moment that it's being measured, is hypothetical. The industry is saying, okay, like, investor, that, rock markets go up and down. If you're investing, if you're opening up an account or starting the investing when markets are up, probably hear it, but you're not paying attention to it. So I think it is very difficult, whether it's the advisor or whether it's a client as an investor, to be able to predict how you're going to react 2 years from now, 5 years from now, 10 years from now, when a market correction occurs, because each time is slightly different and your own personal circumstances is going to be different, from the moment you sign the form to the moment when the event occurs.
And if I'm correct, there's lots of layers to risk, isn't there? There's lots of different types of risk that someone can look at.
There's huge amounts of varieties of risk. I mean, that they can look at. I mean, we talked about two of them: volatility, which is the standard and principal measure in the industry. I think I talked about shortfall, which in my mind is something that people don't pay enough attention to. The idea of running out of money, especially when you're in retirement. You've got other types of risks like liquidity. So, the challenge that for a lot of people that are in housing as a rental property or investment property or into private equity, et cetera, or some of these alternative investments, you don't have liquidity. So if you want to sell tomorrow because you need the money, you take a risk because the price, you may not be able to sell. And if you do manage to sell, it might not be at the price that you want. And then we talk about, obviously, capital risk, which is that the investment is worth nothing or far less than what you paid for it. That one, to me, is one of the easiest ones to manage, because this is what we talk about as a diversified portfolio. If you do your homework and you have a diversified enough portfolio and you hold it long enough, capital risk is, for the most part, I think, a relatively minor risk for investors to worry about.
Okay, we're going to take a quick break, but I also want to make the point, because I know I teach this as well, is know the difference between risk tolerance and risk capacity, because they're two different things, right? You may have a certain risk tolerance, but there might be a
Correct.
certain amount of risk that you actually have to take to meet your goals, and it's important to actually make that distinction.
I think that's a perfect distinction to make. We're going into back to school, so
Yeah.
for parents that have money in an RESP, and if your kids are going to, you're going to need that money in 2 years from now. No matter what your risk tolerance is, your risk capacity may not be that high because you will need that money in 2 years, and that's too short a time for you to take the type of risk that stock market investing entails.